Hello, this is Joe Pryor, the virtual real estate team in Oklahoma, and I want to talk about mortgages for a minute. I work with investors, but this also pertains to owner occupants. So, last year, one of the reasons you started buying a whole lot of houses as as a group of owner occupants is because you could get a 30-year note around 2%. And that was incredible. That is just a ridiculous rate to lock in for 30 years. Because inflation is going to go higher and interest rates are going to go higher. It's like they're paying you to own a mortgage. And so that has to stop, and it is stopping right now. Rates are going up in terms of where it is right now. But let me speak specifically to an investor right now about this. So there's a thing that you can do called buying down the rate. So when you lock in an interest rate, you lock in the whole day. In other words, if it's 4.5% for an investor par. In other words, no points or origination. That's going to be the rate that you get. But if you want to switch to a 15-year adjustable rate or whatever, you can kind of move around. There's another thing that you can do, which is called discount points. And that allows you to buy the rate down. So let's say we take a house at $200,000, you're putting $40,000 down, you have a $160,000 mortgage, and you want to get down to about 3.25% or something of that nature. Well, let's say it's one discount point. Well, you can pay the lender at closing $1,600. In other words, the amount of the mortgage, not the gross amount of the purchase, but the amount of mortgage, and you can get that rate to a lower rate. And you can pay 1.5, you can pay 2. They're going to give you all the parameters in order to do that. Now, I have a rule of thumb about whether to do this or not. So we're talking about a 30-year mortgage. And so let's say, for instance, you want to do a one discount point at that scenario at $1,600. What I'm going to do is compare the par rate to the discount point rate, see what the difference is, and see how long it takes for you to get that money back in terms of cash flow. My rule of thumb for my 31 years has been, if I can get that in 3 years or less, it's worth doing. If it takes me 10 years, no, it's not worth doing the discount points. But 3 years or less means that you've got at least 27 years, 12 payments a year of a lower interest rate. And when I work those numbers, it's very often $10, $15, even $17,000 more that you're putting into your pocket over a 12 to 15 year period. I've even seen a situation where it's so good that you can get it back in 1 year. And the amount that you save and the amount that you make is even greater. I'm not necessarily telling you that this is something that you should do, but it is something that you can do. What we have to do is evaluate it from a financial point of view to see if it's better to stay liquid with that $1,600 or whatever it happens to be, or whether it's putting it into as an investment long-term that's going to give you even greater returns. If you can take $1,600 and get $15,000 back on that amount of money, sounds to me like it's a pretty good investment, but that's what we're going to evaluate with you.